Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 6th of November. Coming up on the show, should you start worrying about your Thanksgiving travel? Well, from tomorrow, flights are set to be cut due to the shutdown. Tesla shareholders are voting on whether to approve Elon Musk's $1 trillion pay package. And pharma giant AstraZeneca posts better than expected results. I'll be talking to its boss, Pascal Soriot, later in the show. So grab your coffee and let's own the morning. Well, the first thing you need to know is that Tesla vote deadline is fast approaching. Shareholders have until midnight to vote to approve CEO Elon Musk's proposed $1 trillion pay package. Tesla chair Robin Denholm has been trying to persuade shareholders to approve this eye-watering sum, but just yesterday, one of the EV maker's top 10 shareholders, Norway's sovereign wealth fund, said it would vote against it. The next thing you need to know is that US companies announced the most job cuts in October in more than 2 decades as cost-cutting accelerates and AI reshapes industries. Now that's according to data from the outplacement firm Challenger Gray and Christmas. Last month, companies announced over 153,000 job cuts. That's nearly triple the number posted last October. And the last thing you need to know is that the shutdown could see travel plans heavily disrupted. From tomorrow, the Federal Aviation Administration will cut flights by 10% at 40 major airports. That's likely to be around 3,500 to 4,000 daily flights. The reduction comes as air traffic controllers are missing paychecks due to the government shutdown, which has now entered its 37th day. The big 3 airlines, as you just saw, American, Delta and United, are all trading lower in the pre-market this morning. Yesterday, the main benchmarks were all higher as the markets took note of scepticism from several Supreme Court justices on the legality of Trump's tariffs, while our Washington correspondent Ben Werschel has been following proceedings.
Definitely my main takeaway was this skeptical questioning you mentioned at the top. We knew it was going to be coming from the court's 3 justices appointed by Democrats, and they delivered for certain. You saw Sonia Sotomayor there. But it's the 3 of the conservative justices that offered really pointed questions as well that I think has upended expectations a little bit here. Perhaps the most, so the 3 we heard from with critical questions were Chief Justice John Roberts and Justices Neil Gorsuch and Amy Coney Barrett, who you also saw there. Perhaps one of the most pointed parts came from John Roberts over the issue of tariffs and taxes. What the Trump administration's case was a kind of legalistic argument that the tariffs Trump imposed, just his blanket tariffs, shouldn't be thought of as primarily about taxes. They even make the case that the revenues, which bring in about tens of billions of dollars every month now, are kind of a knock-on effect to what Trump's overall agenda here is. Roberts was having very little of that, and he pushed back on that, talked about sort of for whatever reason Trump would impose tariffs. The actual thing he's doing here is taxes, and Roberts went out of his way to say taxes on Americans as well. So that was a real challenge to Trump's overall case here. And Gorsuch and Coney Barrett had their own questions on other kind of pillars of the argument here too. What's striking about this as well is not just how much trouble the government's lawyer here, it was the Solicitor General arguing, but how much with these justices, but also kind of in a way with Trump himself. Trump himself would definitely not agree that the revenue from his tariffs are, quote, incidental, which is what the lawyer said today. I don't need to tell anyone that Trump talks nearly every day about how important revenue from his tariffs are to his overall bottom line. He's talked about the big money coming in specifically from these blanket tariffs that are in effect. He even had a line this afternoon in Miami kind of about the money coming into our country and how important it is. The bottom line overall here is that there really has been a market shift here in the expectations. We won't get this decision for a while, but the sense is that Trump's tariff, this part of his tariff agenda, his blanket tariffs, are facing a real challenge here from the courts, more than we expected this morning for certain.
Okay, we're heading for a short break now, but don't go anywhere. Pascal Soriot, the CEO of AstraZeneca, will be talking to me live here on Yahoo Finance. Welcome back. Now, pharma giant AstraZeneca this morning has reported its largest ever quarterly revenue, $15.2 billion. Soaring sales of cancer drugs helped the drug maker beat expectations on sales and earnings in the 3 months to September. Well, let's take a closer look at these results with the CEO of AstraZeneca, Pascal Soriot, who joins us live on Yahoo Finance right now. Pascal, thanks so much for joining us on Market Sunrise. Well, let's start with your Q3 earnings. Normally, with such impressive results, we see a sharp rise in the share price, but so far the reaction has been, it's pretty fair to say, pretty muted. Why do you think that is?
Well, it's a great question, Ramzan. First of all, thank you for having me. And you're right, we had a tremendous Q3, and year to date, our revenue growing 11%, our earnings per share is growing 15%. But I would say the day is young, and we have to wait till the end of this day to see where our share price is going to go. Maybe the market is a little bit down across the board, but let's see toward the end of the day what happens to our share price. But at the end of the day, you know, what's important to us is that we deliver on our financial commitments, but we also deliver on the pipeline, and we are very happy with all of that.
Now, international sales from your report still seem very important for AstraZeneca. Around, I think, 2/5 of your revenue is generated in the US. So what are American consumers buying the most, and where do you see growth in that market?
Well, we're going across the world. We are, doing very, very well in the emerging markets. We're growing in the US. US is our most important market. We're growing tremendously there across all our franchises. Oncology is growing strongly. What we call biopharmaceutical is doing very well. Rare diseases are growing. We hope that by 2030, the US will represent 50% of our ambition of $80 billion globally, so $40 billion for the US. And we've committed a lot of resources, a lot of investment to achieve that goal.
Now, I know you've met with President Trump and have met with the US administration several times. Now, he wants drug prices to come down. How's that going to impact on AstraZeneca?
Well, I think what the president wants to do is rebalance the cost of R&D and the risk associated with R&D, rebalance it across wealthy nations. The US has been carrying the cost of that innovation for many, many years. And the gap has been growing over the years. 20 years ago, it was fairly shared across wealthy nations. But what has happened in the last 15, 20 years is year after year after year, a number of countries in Europe in particular have been shrinking the budget allocated to innovation, pharmaceutical innovation. And the president wants to rebalance it so that Americans pay a little bit less and wealthy nations, in particular in Europe, pay a little bit more. And we continue innovating at the pace we have been innovating.
Now, you talked about investment in the US. You're planning on investing $50 billion in the US by the end of 2030. But you recently paused investment plans in the UK. Why was that?
Well, first of all, if we talk about the US, countries and a large country like the US, of course, want to manufacture the products that are supplied to American patients have to be manufactured in the US to ensure health sovereignty, independence of supply. And we are supporting this view. We're investing in manufacturing. We're also investing in R&D. So that's for our investment in the US. In the UK, what we hope the government will do is increase the funding of innovation. As I said a minute ago, the share of healthcare costs that has gone to pharmaceutical innovation has declined in the last 15 years from 12-15% of total healthcare costs down to 7% in the UK. And so with 7%, in the end, you can't do very much in terms of accessing new innovative products. So we are hoping that the UK government will review this and create additional funding for innovation so we can invest and turn the great science that exists in the UK into innovative medicines like we do in the United States. But for now, our focus is very much to invest in the US and continue supporting innovation in the country, but also manufacturing.
Now, last week, your shareholders voted to elevate AstraZeneca's New York listing, so investors can now buy shares on Wall Street and not ADRs. This is a big blow to London, isn't it?
It's not a blow to London. I think it's a signal that we are very American in our approach. We certainly want to focus on investing in innovation in the country, in the US. We want to manufacture in the US, and we want American investors to access our company, to be able to buy our shares. ADRs are possibilities for investors, but they are more for large investors. Smaller investors would prefer to access shares, and by creating shares, AstraZeneca shares on the New York Stock Exchange will make it much easier for many, many investors to buy our share, and really we want people to benefit from our growth, not only in the US, but around the world. We are the most diversified company in terms of geographical presence around the world.
So London's going to still remain your main listing then for now?
We are listed in London. We call it a harmonized structure, harmonized listing. We are listing in London. We are listing in New York. And, we also listed in Stockholm in Sweden, by the way. And so we really want as many investors as possible to be able to buy our shares. And that's why we created this listing in the US. People will be able to buy our shares on the New York Stock Exchange from February next year.
That's Pascal Soriot, CEO of AstraZeneca. Thank you so much for joining us here on Yahoo Finance.
Thank you, Ramzan.
Okay, we're heading for a short break, but stay with us as I will bring you our trending tickers. Well, despite talk of an AI bubble, multi-billion-dollar deals are still continuing at a pace. Stay tuned. It's time now for today's trending tickers. There's one big winner this morning, some important AI deal making updates, and a few surprising losers too. Well, let's start with Alphabet and its relentless push for dominance in AI. Shares closed up 2.41% and are in the green right now. Remember, they've been performing strongly on earnings, and overall the stock is up over 45% in just 3 months. The main headline here is that Google could get around $1 billion from Apple, which wants to use Google's ultra-powerful AI model to overhaul the Siri voice assistant. That's according to Bloomberg. Next, Google is said to be in early discussions with Anthropic to increase its investments in the AI firm. That's according to Business Insider. Google also said that it's set to announce its biggest ever investment in Germany. Next up, Snap is popping in the pre-market, trading up around 20% after reporting stronger than expected earnings. The Snapchat maker surprised investors with a rebound in ad demand and said user engagement continues to climb. It's also forecasting revenue growth of roughly 15% for the current quarter, a sign its turnaround efforts may finally be taking hold after a rough stretch of layoffs and weak ad spending last year. Robinhood is also on the move after earnings. The brokerage platform posted record net interest income and higher crypto trading volumes, but profits still fell short of Wall Street estimates. The stock is seeing choppy action in pre-market, steadily in the red, but not so dramatic. One dramatic fall to know about: Live Nation, which closed down about 10% and continued to slide this morning after reporting lower than expected ticket sales and revenue from concerts at $7.28 billion versus $7.33 billion estimates. The concert giant is also still facing lots of scrutiny and antitrust pressure. And finally, two IPOs that didn't go very well. Both are in China's EV and autonomous vehicle space. Pony AI and WeRide both fell sharply on their IPO debuts in Hong Kong, down more than 11% and 18% respectively. These two companies are seen as key promising players, but analysts say today they suffered from an oversupply of IPOs in Hong Kong. The financial hub has become the most active equity capital market this year, according to data from LSEG. Hong Kong has now overtaken the New York Stock Exchange and Nasdaq as the world's top listing venue. Now, moving on to a totally different topic. How often do you go to the restaurant? Well, the question may seem anecdotal, but truth is our habits are changing and restaurant companies are under pressure to adapt. The CEO of Carver explained to my colleague Brooke De Palma how his restaurant chain has been navigating changing dining habits.
Well, we've seen the macroeconomic headwinds really impact that 25 to 35-year-old guest segment, where last year, they had a lot of tailwinds, a lot of frequency. Interestingly enough, we've grown market share and wallet share with that group, but their frequency to existing restaurants has moderated as they felt cost pressures from around them, whether that's the reinitiation of student loan repayment, or some of the increase in housing costs or healthcare costs or other cost pressures around them that have had them moderate their visits. And then as we've seen other impacts, whether it's tariff impacts or the government shutdown, the choppiness of the environment, we wanted to be conservative and judicious in trimming our full year outlook to account for that uncertainty.
Brett, it seems like Gen Z is all grown up now, facing these real world problems. Do you over-index to Gen Z?
We don't over-index. It is a core segment for us. And, just want to be mindful of all the challenges they're facing. I mean, when you look at the unemployment rate of Gen Z, it's double the national unemployment rate, which is why we continue to work to underprice inflation. Since 2019, we've taken less than half the price of our industry peers in aggregate. The restaurant industry has taken upwards of 34% in aggregate price since that time, and we've taken less than 17% and 10% less than CPI. So continuing to improve our relative value proposition every year, no matter whether they're facing cyclical pressures or not.
Brett, this is not necessarily a problem just for Cava. We heard from Shake Shack, we heard from Chipotle, we heard from other fast casual chains, Sweetgreen out tomorrow, that they're experiencing this pullback of younger consumers. One, how do you get them back in the door? And two, do you go to maybe those Gen X, those baby boomers who are doing really well in this economy, those high income earners as well?
Yeah, I think, Brooke, when you take a step back, our 2-year comp, our 2-year same restaurant sales actually accelerated from Q2 to Q3, from 16.5% to 20%. So we had accelerating same restaurant sales in the back half of the year. So we had more difficult comparisons. When you look at revenue on a year over year basis, we grew at 20%, and we grew at almost 67% on a 2-year basis. So we continue to grow market share and gain market share rapidly with all customer segments, whether Gen X like myself, or Gen Z, or millennials, or even Gen Alpha, which is our newest generation that's starting to come to our restaurants. So we have a really diverse appeal, and it's resonating more than ever when you look at our new restaurant openings. So we noted that our new restaurants are opening at record levels, north of $3 million AUV, average unit volume run rate. So we see the structural strength of our business, and just being mindful of the cyclical headwinds that consumers and some consumers are feeling more than others today, and making sure we're putting forward that value proposition to make our...
Well, we start with some earnings that have just dropped. Warner Brothers Discovery shares are in the red in pre-market. The main headline from its earnings print is that Q3 subscriber growth was a miss, with just 2.3 million versus the 2.54 million estimated. EBITDA also was a miss, coming in at $345 million against an estimate of $354 million. In addition, the CFO earlier this week sold $5 million worth of shares. Now remember, Warner Brothers Discovery has actually been at the centre of takeover talks involving potential bidders, including Paramount, Skydance and Netflix. Shares have benefited from the buzz so far, in fact up about 18% in the last month. We'll see what happens after this pretty, mixed report, I think is an understatement. Okay, next up, some news about Marvell Technologies. Shares of the provider of data infrastructure and semiconductors are flying after a Bloomberg reports that SoftBank, the Japanese conglomerate, has been weighing a blockbuster takeover of the company. Shares are up around over 8% in the pre-market, continuing to build on yesterday's rally. But remember, they have been sliding quite a bit in recent months. We'll keep watching this story on Yahoo Finance. One company reporting positive news is the shipping giant Maersk, who have raised their outlook after global trade appeared to be more secure than feared after months of tariff uncertainty. The Danish-based firm beat its profit expectations and raised its end-of-year guidance. But this wasn't enough to sway investors, with shares dropping around 5% after the market opened. Maersk CEO Vincent Clerc says that guidance represents a story of resilience. Overall stock in the company is up around 8.5% this year to date. Now, Qualcomm reported its fourth quarter earnings after the bell on Wednesday, beating expectations on the top and bottom lines. The company also issued better than anticipated guidance of between $11.8 billion and $12.6 billion versus an anticipated $11.59 billion. But the company said it also took a one-time non-cash tax-related charge of $5.7 billion related to President Trump's One Big Beautiful Bill Act. And its shares are suffering the pre-market, as you saw. Now, Daniel Newman, CEO of Futurum, gave his reaction to my colleague Josh Lipton to those results as they broke.
The numbers came out pretty tidy. What was it? A beat on revenue, beat on earnings, beat on guide. You got to like that. I mean, this is a company that's in transition. They are trying to tell a new story. They've had some really good success in automotive. They've expanded their business into IoT. The core business has been somewhat rate limited, but what I believe they're showing here is that it's stable. They had the Apple revenues falling off over time, and they've had to prove their wares there. But overall, I like the numbers. And by the way, I've been calling this company a dark horse for a while. You've got that data center upside. You've got the automotive business. You've got IoT. Like I said, the core business is stable. I like the company because it trades at like 14, 15 times forward with all that potential. And I think their story is more of a 6 to 8 quarters into the future story.
I want to get to the AI part of the story, but first, just the bread and butter. Company does generate most of its revenue from smartphone chips. So I'm curious, Dan, as you look ahead 2026, you look at that smartphone market, what does it look like? What does device growth look like to you?
Well, I think we've seen to some extent that these numbers continue to sort of grow steadily but slowly. We saw it just last quarter with Apple, the iPhone 17, excitement, all the enthusiasm about that at the top end, which is where Qualcomm really does its best work. Those very high-end devices for Samsung and others, that's where we're starting to see growth, and that's where a lot of that AI enthusiasm and excitement exists. And I think Qualcomm's done a good job protecting margins, winning at the high end, and that's where I think they need to win while they're in this process of diversifying. But to your point, most of their revenue, yes, but their diversification is becoming more and more. A mid-double-digit percentage of their business is now diversified away from the smartphone.
Apple switching to in-house modems. If I'm a Qualcomm investor, how should I think about that?
They've been telling this story for years. They've already baked it into the numbers. This company, with their model over the next 3 or 4 years, I spent some time with their CFO today talking a little bit about this, just the reminder of this. They have been very upfront about this. But like I said, look at the number. They're beating, they're raising above the consensus midpoint. But here's the thing, Josh. They came out, they announced that AI chip.
Yep.
And you saw it just flew, right? Didn't it? It went up to like 20% at some point in that day.
That got investors excited.
It came back down. But the company understands they need to be in physical AI. I think they're going to enter into robotics. I think they're going to, see this IoT number expand. Automotive, $45 billion plus pipeline. AI chips, they only need to win like 1% of market over 4 or 5 years to add $6 or $7 billion, we're estimating, to their top line.
Okay, before we go, let's have a quick look to see where Wall Street could open later on this morning. And it's a pretty sort of uninspiring start, to be honest. It's quite flat across the board. In Asia, stocks were a lot higher. In Europe, they seem to be struggling for direction as well. They're slightly low, despite some pretty positive corporate earnings out of the region. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.